Hello, my name is Michael Clements, and I'm the Managing Director of Synergy Research Services, which provides investment opinions on a model portfolio of 50 companies that we've chosen from the biggest, best, most resilient, profitable, and growing companies around the world. This is the third of a series of informative videos that we have created for investors, and its purpose is to acquaint you with the concept of risk versus volatility. Beta, which is a volatility measure per the capital asset pricing model, or CAPM for short, is not risk. Only the permanent loss or permanent impairment of capital equates to risk. And the fact that shares of companies bounce up and down in value every day of the week does not equate to risk. If you are a patient investor and can ride through the volatility without selling, then you did not experience any risk, but you did experience volatility. And sometimes the volatility can be scary, such as we saw in 2000, 2008, 2020, and at other times in history. But in retrospect, they all presented fantastic buying opportunities of great companies. There's another aspect to risk that's worth exploring, given that some companies are more likely to fail than others, and that is that buying companies or securities in your portfolio that are riskier than alternatives does not necessarily lead to more reward. They can easily cause a permanent loss of capital. As such, as Howard Marks says in his book called The Most Important Thing Eliminated on page 43, the traditional risk-return graph is deceptive because it communicates the positive connection between risk and return, but fails to suggest the uncertainty involved. It has certainly brought a lot of people a lot of misery through its unwavering intimation that taking more risk leads to making more money. The following version of the graph is more helpful. It's meant to suggest both the positive relationship between risk and expected return, and the fact that uncertainty about the return and possibility of loss increases as the risk increases. When you look at the attached graph from Howard's book, what he's saying in simple English is that as you move along the lower axis from left to right, you take on more risk. In theory, that means you should also be moving up the vertical reward axis, which is somewhat true. But Marx basically says the more risk you take on, the wider the range of outcomes. You can either be a hero or a zero at the far right of the risk axis, whereby the parenthesis shows that you can either make a ton of money or lose it all. At the left end of the risk axis, the parenthesis is a lot smaller, indicating that your range of outcomes is also a lot smaller, and while you might lose some money, you won't lose it all, at least most likely. There's always exceptions, which we talk about occasionally in our weekly summary emails regarding supposedly safe investments to go sideways. It happens all the time. To us at Synergy Research, it's the most important modified graph in finance we've ever seen, and it should be posted on a prominent place on every investor's wall. Thank you for watching. In the next video segment, we'll deal with examples of risk.